Welcome to the Simplified Stock News channel. Today, we're diving into one of the most essential tools in the stock market, the moving averages indicator. What is a moving average? Simply put, a moving average is a calculation that smooths out stock prices over a specific time frame. For example, a simple moving average adds up the closing prices over a set number of days and divides by that number. The result? A line on the chart that helps you see the stock's overall direction, without the distractions of daily price fluctuations. How to use moving averages. Here's how you can use them effectively. Support and resistance levels. Moving averages can act as dynamic support or resistance levels. For instance, in an uptrend, the stock price might bounce off the moving average, using it as support. In a downtrend, it could act as resistance, preventing the price from moving higher. Crossovers for entry and exit signals. A golden cross happens when a shorter moving average like a 10-day crosses above a longer one like a 50-day, signaling a potential buy opportunity. A death cross occurs when the shorter moving average crosses below the longer one, signaling a potential sell. These crossovers are widely watched by traders and can indicate major trend shifts. Combining with other indicators, moving averages are often paired with tools like RSI or MACD to confirm signals and avoid false trends. For example, a bullish crossover combined with RSI exiting the oversold zone could be a stronger buy signal. Adjustable time frames. You can customize the time frame of moving averages to suit your trading style. Day traders often use short periods, e.g., 5 or 10 days, while long-term investors prefer longer ones, e.g., 50 or 200 days. Testing different settings on historical data can help you find what works best. There are several types of moving averages to suit different trading styles. Simple moving average SMA, a straightforward average of past closing prices over a chosen period. Exponential moving average EMA gives more weight to recent prices, making it more responsive to changes. Weighted moving average WMA, similar to EMA, but applies even greater emphasis on recent prices. Key time frames for moving averages. Popular time frames include 10-day moving average, ideal for short-term traders. 50-day moving average, useful for identifying medium-term trends. 200-day moving average, a favorite among long-term investors for spotting overall market sentiment. Remember, the right time frame depends on your trading goals and the market conditions. If you found this explanation helpful, don't forget to like, subscribe, and hit the notification bell for more simplified stock market tips.